Good afternoon. My name is Allie Johnson, and I will be moderating today's webinar. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Richard Todd. He's a Vice President and Business Community Manager at City National Bank. He'll introduce himself and then take us through a presentation on what lenders look for in your loan application. Please feel free to ask questions using the Q&A function. We'll respond to them as we go along. And for any questions that we don't get to today, we're happy to address through our no-cost one-on-one services or connect you with resources that can help. We'll share a recording of this webinar as part of our follow-up email. So, what is the Capital Pathways program? It's a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll kick things off with a program overview, then go through the program eligibility and finish up with the outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses and nonprofits build the systems and habits needed to become capital ready. This matters because businesses that are less prepared can often self-select out or fail their loan applications. And these early failures correlate to a lack of adequate capital. Higher cost alternatives typically don't build long-term capacity, and ultimately only half of the loan amounts requested actually reach small businesses and nonprofits. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible? Very small businesses and nonprofits at any stage who face challenges accessing traditional financing. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. We start this process with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through our program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we also partner with a law firm to help with more complex topics related to business registration, trademarks, and contract and agreement reviews. In addition, we offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender preparation. These loan application readiness services include both webinars and one-on-one individualized support. And our webinars cover topics such as today's, what lenders look for in loan applications, as well as interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender who provides one-on-one support to those looking for capital. Finally, our credit building advising will help you review and interpret your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for better financing options and terms. So if you're interested in getting started, you can reach out to through our website at virginiasbdc.org/programs/capital-pathways. Or you can reach out to me directly at capitalpathways@virginiasbdc.org. And I'll share my email and our website link in the chat for everyone to have. So over to introductions now. As I mentioned before, my name is Allie Johnson. I'm today's moderator, and I serve as the program and intake coordinator for the Capital Pathways program. I have a professional background in economic development, small business support, and access to finance projects, both domestically and internationally. Our session today will consist of a 60-minute presentation. And again, feel free to ask any questions throughout using the Q&A function. We'll respond to them as we go along. And as I said, for any questions that we don't get to in this webinar, we're happy to address through a no-cost one-on-one services or connect you with resources that can help. We'll share a recording of this webinar in a follow-up email along with any resources that Richard shares with us. Speaking of Richard, I'd like to pass things over to you, Richard, to introduce yourself, tell us a bit about your background, and start the presentation.
Thank you, Allie. Before I get started, I want to first thank Allie and the Virginia SBDC for allowing myself and my colleague, Courtney Davis, to present on behalf of City National Bank. But again, good afternoon, Virginia. I'm Rashad Todd, Vice President and BCM. BCM stands for Business Community Manager at City National Bank, and I cover the Maryland, DC, Virginia, and a little bit of West Virginia regions. Before I get started, I'll allow my colleague, Courtney Davis, to give you guys a quick intro of who he is. If he can come on stream.
Everyone hear me? Hello?
Yes, sir.
You hear me?
Loud
Okay,
and
hi.
clear.
Hello everyone. My name is Courtney Davis. I'm a business community manager. I am actually in the New York market. I just want to say, I'm here today to as much as possible, and I'm trying to get my video going. And yeah, I think it's finally on. So I'm really here today to help to support Rashard and more importantly, to be able to answer some of your questions as you go along. Don't be afraid if you have any questions or so you want to put it in the chat. I'll definitely record it so that at the end we answer all your questions. So don't be afraid, just be willing to ask as much as you can. We are bankers and we are here to answer all the questions that you have today. Thank you again, Rashad, for giving me an opportunity to be a part of your call.
Thanks, Courtney. So, my goal today is very straightforward. I'm going to take you guys behind the commercial underwriting curtain so you better understand how lenders think, what we look for, how to get your business positioned for capital from a place of strength. By the end of our time together, you will have a clear understanding, my apologies. You have a clear understanding of what banks look for, how to match the right loans, the right purpose, why cash management plays such a crucial role in your business growth, and how building the right ecosystem around your business can make the capital process a lot smoother. Like my colleague Courtney said, also Allie, I'm gonna have a Q&A session. I'm gonna also pause at each slide, maybe a minute or two to have any questions before I move forward, and we'll go from there. So let's get started. Right now we have our table of contents. I'm going to cover what do banks look for, when should you seek financing, different purpose and types behind financing, your business ecosystem, and what is cash management and why is it important. The first slide is what do banks look for? And we have two circles here, the story and then your financial performance. Let's start with the story. Because before underwriting looks at spreadsheets, they want to understand the business behind them. So first tell your banker or your branch manager, why did you start your company? What problems are you solving? Where do you see your business going in the next 12 months or the next 3 to 5 years? Your story gives your banker context. It helps us advocate for you internally and explains why, if you have any challenges in your business, why they don't define your long-term trajectory. Before I move forward, I want to also say, when you're choosing a bank, be mindful of your bank's intentions. If you're a new customer in a bank and you walk into a branch and the business banker or the platform or the teller person isn't taking down notes about your business, think of that as a red flag. If you go into a hospital for a first time and meet your doctor, a PA, any kind of a professional or medical side, they have a folder in their hand. So think about that as the same thing about choosing a bank. You want a bank that understands your business and understand you. So they want to have the intentions of learning about you, asking questions and writing it down. Also, with your current bank, be mindful if you have a business banking relationship manager, a BBRM. He or she is your main business advocate at the bank. So if your bank RM has not given you a call, that's a problem. So call your bank, ask for your business banker, he or she, and you want to learn about their process and then explain to them your personal and your business long-term and short-term goals. Because again, the better they understand the left side, which is your story, the better they can be your advocate for the bank when we're going to do underwriting process. So let's get into management experience. You want to explain to your banker what expertise do you and your team bring? What makes your leadership credible in your industry? Experience reduces risk, and that matters in every credit conversation. Next, we have operations. Walk your banker through how money actually moves through your business. I call it the dollar journey. What happens when dollar comes in, where it goes in your business, and how does it leave your business? Also talk to your banker about how you guys generate revenue. How do you invoice? How long does it take to collect? Where is your biggest expenses? And when the operations are clear, it becomes much easier to structure credit that actually supports your growth instead of creating pressure. Next is your plans and objectives. Be very clear about this. If you plan to add equipment next quarter, expand to a new market, or buy real estate, say that early. When a banker understands what's coming, we can structure capital proactively instead of the other way. So coordinate with your CPA, and we can also do that with tax strategies and keep you in a position of being bankable. Lastly, will be your competitor intelligence. You want to be able to articulate who else is serving your customer. How are you winning your market share, or how you're going to win your market share? A clear understanding of your market strengthens the overall credit story. Now let's jump into the right side of the financial performance. Lenders are not just looking at one strong year. You're looking for patterns. The first thing we analyze is revenue direction. Is revenue growing? Is it flat? Or is it declining year over year? Usually it depends on the loan amount. We go off a 3-year trend. The current year, the last year, and the last 2 years. And again, that depends on the loan amount. If it's a small amount, like 100,000 or less, maybe just you look at your current financial, your current balance sheet P&L. If the loan is over 250, banks may require 3 years of financials, 3 years of business returns, personal returns, your interim P&L and balance sheet. If you file a 1040, then we need just all personal returns and your Schedule C's and K1s as well. But again, the loan amount determines how many years of financials the bank will request from you. Now, let's just say revenue jumps significantly. We're going to ask why. Was it one large contract? Was it due to pricing change? Was it an expansion? Rapid growth without infrastructure can raise as many questions as declining revenue. That's key. Next, you look at your market stability. Are your gross, and net margins consistent? If revenue is increasing, but your margins are shrinking, banks want to understand what is driving that. Higher labor, higher material costs, discounting to win business. Margins compression tells a story about pressure. Then we look at cash flow, not just profit. So a business can show profit on paper and still struggle to generate enough cash flow to cover their debt obligations. We focus on what's called a DSCR, and I'll get more into that until I think my fourth slide. But the DSCR it means your debt service coverage ratio. Again, DSCR, debt service coverage ratio. All that means is, can your business comfortably make its annual loan payments from recurring cash flow, not from one-time gains, not from any asset sales, but from core operations? Then we want to understand if your business has any kind of seasonality behind it. That's a major factor. If your business has, peaks and valleys, please show that clearly. 12 to 24 months of monthly performance helps us see patterns instead of guessing. When seasonality is explained and managed properly, it does not hurt you. When it's ignored, it creates uncertainty. We also evaluate any expense trends. Is your operating expenses scaling responsibly with revenue, or are your fixed costs rising too quickly? A healthy business shows discipline as it grows. And lastly, we look into any customer concentration. That matters as well. And as you can see now in the government contracting sector, a lot of 8A programs are having a hard time securing liquidity, securing capital, because their main business is tied up in one sector. That's their customer concentration. Usually banks have a metric. If at least 10% of your sales is from one customer, banks consider that a red flag. So be prepared to explain that customer and your business relationship. Do they pay on time? How often do they pay? How long do you have their business together? That matters the most. So again, if one customer represents a large part of revenue, using around 10%, we need to understand the stability of that business relationship. And finally, we look at your balance sheet strength. Is your AR growing faster than revenue? Is your inventory building up? Is your accounts payable stretching longer than usual? These shifts can signal growth or strength. The difference is clarity and control. So the bottom line I'll say is trends matter more than snapshots. So one strong tax return does not secure financing. A consistent upward trajectory with clear reasons behind it does. And I will pause for a minute or two for any question before I move forward. Okay, I don't see.
There's no question. Sorry.
Okay.
There's no question in the chat right now.
Okay,
For sure.
perfect. Thanks, Courtney. I'll move forward. So, next slide we're going to talk about is the 5 C's of credit. Most banks still evaluate businesses using the 5 C's. Those are, as you can tell, character, capacity, capital, conditions, and collateral. Now, here's the misconception when it comes to character. A lot of business owners, mostly in the early stage of their business, startups, do not have a clear understanding that your personal credit score matters a lot in business financing. So that character piece is very key when it comes to financing for businesses. It reflects your financial behavior and your overall credibility. That includes your personal credit. If you are tax compliant, how well do you separate business from personal finance? Consistency and transparency goes a long way in this character for the C. Next, we have your capacity. That is your business ability to repay from your cash flow. Again, not revenue, from your cash flow. Lenders want to see a stable performance and realistic projections that account for seasonality or those peaks and valleys. Third is capital. That's your own, that's the owner's skin in the game. That's your own investments and your financial cushion behind your business. Clear as day. Fourth will be your conditions. That's if you're able to understand the broader environment around your industry and the industry trends. Also including to that see any customer concentration you may have. Understand the economy and how the economic factors affect your business. Banks own the risk appetite, and that plays a role in the decision if you as the owner can understand how the economy affects your business. Last would be collateral, and that refers to any assets backing a loan like real estate, any cash reserves, any cash, value life insurance and securities, etc. Now, I'm going to pretty much break down, get into again why that personal credit and liquidity still matters. So again, like I said earlier, even in business lending, your personal credit score carries weight. It signals your payment behavior and your responsibility as a borrower, especially when a personal guarantee is evolved. Now, personal guarantees, PGs, are 95% going to be used in business lending. Doesn't matter if you're in business, I'm sorry, business banking, small business banking. When you get into larger loans, like in seven figures and eight figures, a lot of times you may not be able to use a personal guarantee, or if you're a nonprofit, nonprofits don't have to use personal guarantees, or if you're a law firm, um, sometimes the partners don't want that personal guarantee loan, or if you're a doctor or a practice, it's different industries can that can vary a personal guarantee. Also, if you're doing real estate, more so if the loan is backed by Fannie Mae or Freddie Mac and you're buying apartments or multifamily, a lot of times the properties can support the loan, so it's non-recourse, meaning non personal guarantee. Now, here's one thing that a lot of strong business owners overlook. Banks do not just look at how much you own. They look at how your assets are structured. That's the key. So if most of your wealth is tied up in one sector, and that sector happens to be real estate, that is an illiquid asset. It limits your flexibility from the lending perspective because liquidity matters on both the business and the personal side. So cash and having accessible reserves so that you can meet your obligation without selling long-term investments. You can have a lot of assets on paper, but without accessible liquidity, your risk profile may still feel tight to a lender. So the goal is always a balance. Growth assets paired with enough liquidity to navigate opportunity and any uncertainty for your business. Excuse me. Now, I want to also get into that banks have industries that we lean into and ones we avoid. So be mindful and when you're talking to your banker or your BBRM, like I said earlier, ask the questions. Interview your bank. Ask them, does this bank have an appetite for my industry? You can also look into banks' balance sheets and see where they're lending the most into. Some banks lend more in real estate, some banks lend more in maybe retail businesses, professional services. Do your homework before just going to a bank. Don't just go off the bank's name and say, oh, I bank with Chase or BOA or etc. based on just or say National Bank. Do your homework first. Be mindful because again, you want to build that bond with your bank and grow with them throughout time. So again, that goes back to the bank's intentions. If the banker you're talking to is not taking down notes about your business or yourself, think about it as a red flag. Because you deserve a bank that understands your industry, advocate for your growth, and structures capital around where you're going, not where you are today. So again, I'll pause for a second or two before I move forward. Any questions?
None in the Q&A at this time.
Okay, thank you. I'll move forward. Now, like I mentioned earlier about that DSCR, again, as you can tell, that stands for your debt service coverage ratio. At its core, this is how we measure your ability to repay your debt from your business cash flow. The formula, as you see, is very simple. It is your net operating income divided by your total annual debt payments. But think about it like this in real terms. After you pay your operating expenses, how much cash is left? Is it enough to comfortably cover your loan payments? That word comfort matters a lot. Banks are not just looking for you to break even. We're looking for a cushion. So most lenders want to see a 1.25 coverage ratio. What that means is for every dollar of debt your business generates, $1.25 in cash flow. That remaining 25 cents is your safety margin. Look at that from that perspective. Now let's make that more so practical. If your business generates 25,000 in net operating income and your annual debt payments are 1,200, your coverage is very strong. That tells us payment is not a concern. Now, if you flip that, if your business generates 15,000 in net income and that same 1,200 in debt, you're right at that 1.25 threshold. You should be. That is more acceptable, but there's very little room for error. And if you fall below that 1.25 times, this is where lenders begin to pause. Not because the business is bad, but because there's not enough cushion to handle any unexpected changes. I believe the SBA uses 1.15 times. Some CDFIs also may have a lower cash flow metric. CDFI stands for Community Development Financial Institution. So a lot of banks use 1.25 times. The SBA may use 1.15 times. Also with a CDC or CDFI as well with that 1.15 times. And that's just your business as a standalone for its cash flow. We also look at it from a global as well. Global is including your business and your personal debt and your cash flow. So that's a global DSCR. At a global, banks may look at it from a 1.10 times or 1.0, depends on the bank. Now, this is where a lot of business owners get wrong. Because again, a lot of owners tend to focus on revenue instead of cash flow. Revenue does not repay loans. Cash flow does. They tend to also overlook their existing debt. So when we calculate things, or this right here, for example, we're looking at your full debt picture, not just the new loan you are requesting. And timing matters. Again, if your AR, which is your account receivables, are slow, or your expenses spike, it impacts your ability to cover debt, even when your annual numbers look fine. So I told all my clients and prospects, the real takeaway is this right here is not a bank metric. Look at it as a business health metric. If you understand your DSCR, you understand how much room you actually have to take on growth, to hire, to invest, or to expand without putting pressure on your business. A good banker, he or she would never put you in a spot to put any pressure on your business cash flow. Because your cash flow clearly supports your debt. The conversation shifts from can we approve this to how do we structure this loan the right way? And I'll pause again for any questions in the chat before we move forward.
We do have one in the chat. It is, how do the 5Cs and the DSCR work in a business acquisition context rather than in a current business?
So how does the 5Cs and DSCR work into a business acquisition, not on a current business? That is a great question. So a lot of times when we're doing a business act loan, you want to understand and get the business evaluated. So if you are a new borrower and you're buying a business, we're going to still look at your experience. We're going to still look at your personal credit score. We're going to still look at your conditions. If you're able to understand what you're about to step into as far as the industry, who your team going to be, And then we're going to also look at the current business, where they are financially currently and where they were historically. Look at their EBITDA, look at their cash flow. And if the business cash flows to a 1.25 times, and if the borrower has good credit and they have the money down for it, 'cause a lot of times you're buying a business, you may put down 10%, that's goodwill from the SBA. A lot of times loans will get approved that way. So the 5 C's is utilized in every business and the DSCR. The DSCR is cash flow, and the 5 C's allow us to understand who you are as a borrower. And if you understand, again, your business industry, what's your experience, you have the collateral for it. And if the business, the capacity, the DSCR has the capacity to support the loan request. So yes, it does matters. And I hope that answers your question. If there
Thank
is
you.
no
That's
more
the only
question,
question we had.
okay. So I'll go ahead and move forward. So this slide is, when should you seek financing? Let me frame this in a way that most owners will understand. Think about financing the same way we think about legal or strategic planning. You do not wait until you're under pressure to get organized. You prepare while you still have leverage and options. So the strongest time to seek financing is when your business already looks stable on paper. So if that's consistent revenue, those healthy margins I talked about earlier, and if your cash flow is predictable and you have clean financial reporting. This is when lenders are most willing to extend capacity, because we are underwriting from strength, not stress. Another mindset shift, financing should be tied to long-term growth, not short-term emergencies. So if you know expansion is coming, start that with your banker conversation early. Growth usually requires upfront investment, like hiring talent, investing in systems, expanding your services. If you're a government contractor or a commercial contractor, taking on larger contracts often means cash goes in before revenue fully catches up. So planning ahead allows you to structure your capital in a way that supports that transition, that transition, instead of reacting to it. And again, many owners just get stuck in waiting too long to pop capital. Honestly, they feel as though they should wait when things are perfect, or they feel as though the economy is too bad and they just wait. Don't do that. Again, if your business is profitable and your cash flow is clean, apply for the loan and utilize that loan as a safety net in case you need it. So a lot of owners tend to wait until the AR slows down, when payroll feels tight, or when a new contract shows up that requires immediate funding. By that point, the numbers often reflect pressure instead of stability. And lenders like myself make decisions based on what we see today, not what your business looks like 5 months ago. So always think about this. When you see financing from a place of strength, you control the structure, the timing, and the narrative. When you wait until urgency drives the conversation, you lose that flexibility and the options narrows a lot more quickly. And I'll pause for this slide before I move forward as well. Give it a 1 or 2 minute wait. Okay, I'll go ahead.
There's no question. You could continue, Sean.
Thank you, Courtney. Now, this slide is my favorite slide of the whole deck, because I talked about capital. Now, as you can see, this is a short-term and long-term financing. So, capital is designed to move with your operating cycle. Money you expect to use and bring back into cash within 12 months. That's for short-term financing. My apologies. For short-term financing, it is the cash you expect to bring back into your business within that short term, so within that 12 months. It supports your day-to-day operations, like payroll, your vendor payments, inventory purchases, any marketing spend, or covering that gap between when you pay your expenses and when your AR comes in for cash. That's also very common. As your business grows, we know that cash flow timing becomes more complex. Again, like I said earlier in the previous slide, revenue may be increasing, but that does not always mean that cash is arriving at the right moment. Um, the tools you want to use for short-term financing, which is most effective, will be a line of credit and a commercial credit card. A LLC gives you that flexibility. You draw when you need the working capital, and you pay it down as your cash flow normalizes. It helps smooth out that growth without forcing you to slow down your business momentum. Now, for a commercial credit card, that works well for smaller operational expenses, and they can also help you track spending and build your business credit. But it should be managed with intentions. You can also have employee cards as well. Now, if we jump into long-term financing, that is capital that is structured for investments that will produce, value over several years. Anything that is 12 months and over will be considered long-term financing. So, like expanding into a location, buying equipment, acquiring property, investing in your business infrastructure, all that requires and it needs support for long-term growth. A lot of times the tools for that would be a term loan, or it'd be if you're buying property, which is a CRE financing, and that stands for commercial real estate. So CRE financing or term loans. Term loans allow you to spread the cost of expansion over time. So your operating cash flow stays strong while the investment begins to generate returns and also appreciates. When it comes to CRE financing, that is again mainly used around property, and that is structured around the life of that property. So the repayment timeline aligns with the asset, which protects your liquidity as you grow. Now, be mindful of utilizing these actual facilities correctly. A lot of times, owners tend to use the product incorrectly. For example, do not use a short-term tool for a long-term asset. So if you get a line of credit, please do not buy a vehicle with that line. If you do, the payments would not bring down that principal fast enough. Short-term financing payments are always interest only. So if you put a long-term asset on that line of credit, you're only paying on the interest, and that principal is still there. So it's depreciating and not being paid down. So in your balance sheet, you're going to be what's called over leverage. That means too much debt on the balance sheet. So you use short-term tools for short-term projects, and use long-term tools for long-term growth projects. So as your business begin to scale, I like to give my owners and prospects different options of where to acquire capital. So as the business begin to scale, capital usually involves in layers rather than all at once. So most companies begin by strengthening their core banking bond with another bank by having clean financial reporting, consistent deposits, and a well-managed credit facility like a line of credit that can create the foundations of a law for larger and longer convo down the road. Many growing businesses will also look for, like I said earlier, these CDFIs or the CDCs or any other regional lending partner when they need more flexibility around the expansion, their working capital, or any community-focused projects. We also have the SBA-backed financing. That's a strong option for funding equipment, real estate, and you structure growth also because it allows the business or the owner to access longer terms while preserving their liquidity. It also gives you a smaller down payment or a smaller equity injection of 10%. And then as your financials begin to mature, businesses tend to look more at banks for traditional financing. We can structure larger facilities that align with your cash flow and your business growth strategy. As only if you're talking to your BBRM. Again, he or she has to understand your business, again, short-term goals and your long-term goals, and the bank has to have an appetite for your industry. If all of these are not aligned, your business growth at that bank may be limited, or you may have difficulty receiving capital or assistance. So again, growth strategy is not just about approval. It is about aligning the right structure where the business is today and where leadership wants to go next. Now, I'll talk about how to avoid some high cost financing traps as well. So be careful with products that promise speed but create pressure, like those high interest short-term loans that keep renewing over and over, or those daily repayment structures that pull out cash too quickly. Also, those MCAs. MCA stands for Merchant Cash Advances. They look simple, but they carry significant costs. I had a client of mine who had an MCA loan. Her rate was, I believe at the time, it was 65%. That is a high interest rate. So again, those look simple, but they carry huge costs. So a responsible financing partner will walk you through the true costs, repayment timeline, and how structure performs if revenue slows down. The goal is to always use capital as a tool for stability and growth, not as something that quietly, erodes your margins and your business cash flow. Oh, another resource would be look into your economic development associations. A lot of counties and state levels, federal have an economic association. Like Fairfax has one. So does Virginia, DC, Maryland, different counties, and they are designed to help businesses, grow, expand, and sustain. So you got your SBA financing, you got CDFIs, you also have CDC. CDCs are primarily for SBA 504 loans. But when it comes to that loan, it's a partnership with the bank and also that CDC. So it limits both exposure at both parties. And again, that owner still has that 10% injection of equity. So we got SBA financing, CDCs, CDFIs, your economic development associations, and also you have your SBDCs like Virginia, Allie and her team. You also have in Virginia the SBSD, that stands for Virginia Small Business Supplier Diversity, and they have numerous programs for capital. And I'll pause quickly for a quick Q&A.
First question is an SBA loan slash guarantee the only way to secure a 10% down payment loan?
Great question. Great question. I wouldn't say it's the only way, but it's the most common way. Again, every bank is different. Every bank has different programs, different options. Usually when it comes to conventional lending, it'll require 20%. But let's just say that bank has a special program where it's requiring 10% for that term loan or LLC or that you're buying a property. But a lot of times the banks will be 20% or higher with banks. Also, a bank be mindful of this. If you're buying a property for a bank, their property type matters. So if you're buying industrial, retail, flex, multifamily, mixed use, all of those have different down payment structures based on that property type and the property risk behind that. Also be mindful of what banks call special purpose. those are like churches, car washes, auto shops, because that foundation, that property and the facade is mainly utilized for that one industry. So it's hard to like really get that property if the borrower tends to not pay their debt back. But banks are not in the business to get assets liquidated, but in the chance that was to happen, it's harder for banks to sell those type of properties. So that will require a larger down payment, sometimes around 30%, 5%, 40% down if you're going to buy that type of property type and that bank supports that request. But the SBA usually has a 10%. Some CDCs as well have that. CFIs make a program where it's 10% or 15% down, or sometimes you may have 100% financing. I know when you're like in the industry of being a doctor or professional medically, a lot of banks have programs that are 100% financing, but no money down. 10-year term, fixed rate, there you go. So it's all about shopping around, talking to banks, talking to bankers, talking to different resource partners to understand what they can offer you in that moment in your business. And I hope that answers your question.
Thank you. Next question
Yes.
is there a workshop to help show you how to get a business line of credit, or I'm guessing personal line of credit or HELOC, and which one is better for the short term or for a new just starting business?
Yes. I'm pretty sure that Allie and her team have workshops numerous around the months to have you understand which loan product is for your business and best for you for growth. Also, talk to Allie and her team. Talk to your banker, and is giving your plans to your business. And if they're responsible, they can really walk you through your business trajectory with the actual banking partner. He or she should be able to look at your business requests, your financials, and tell you where you are currently and where you should be 1 2 years, how to get there the right way. So again, you don't want to make the decision by yourself, utilize your partners. And I hope that answers your question.
Thank you. I'm not seeing any others in the queue, but as a reminder to folks, please do use the Q&A function to submit your questions.
Okay. And thank you, Allie. Again, the main takeaway for this slide is growth is really done by being in isolation. When you're leveraged in the broader ecosystem around your business, capital becomes more strategic and expansion becomes more sustainable. I'll move forward to the next slide. Second. Perfect. What is cash management? Cash management is the process of monitoring and controlling the flow of money in and out of your company. It's a fundamental part of your business operations that helps ensure the company has enough funds to operate and that it can take advantage of opportunities and weather any financial uncertainties, such as having your AR and your AP, and then that third wheel is the efficiency. Then the next slide is going to talk about the different options you have in cash management. Also, cash management at a bank would be called treasury management as well. You have your ACH, direct payments, that CCC card, any lockbox, any emergency services. Those are all the tools plus more that goes into your cash management at the bank. So when you're talking to your BBRM or your partner for finance, it can be Allie, her team, a banker at your bank, anybody. Be mindful of the cash management options they give you, especially if you're a nonprofit. Nonprofits tend to need cash management a bit more. I won't say more, but they need it. I'll say more. Nonprofits tend to need cash management more than being in for profit. So if you're a nonprofit business, be mindful of the services they can offer you for cash management. And my next slide, I'm going to talk about your business ecosystem. So that banking advisor, like I said earlier, your BBRM is key to your banking experience. 2 keys. Understanding who your banker is, who your business banker is, he or she, understanding if your bank has an appetite for your industry, those are key. Those will determine your entire banking experience from being exceptional to being questionable. You can also utilize again Allie, her team as an advisor because they can pretty much point you in the way to go to find a capital partner. You want to have a good bookkeeper or CPA because you need clean financials. A lot of business owners tend to do things themselves. And again, I understand you wear so many hats. I understand as a startup or early stage it can be pricey, but it costs to do business. You want to have clean financials because that person on your team as a CPA or bookkeeper can produce that for you when you need it. You don't want to have any what's your business financial hiccups because that can delay your request for financials. I'm sorry for capital. Next, you want to have a business strategy. Again, that goes into pretty much spending your terms and your goals from 12 months or less to 3 years to 5 years. Be able to define your goals and your targets. Hold your team accountable and yourself and do monthly check-ins. And that goes to my last point, that assessment. You want to have monthly, weekly, or quarterly periodic assessment of your business. Know where you are right now. It is, I think it's almost the end of March, March 18th. If I ask the owner right now at March 18th, is your business profitable? And you can't tell me it's a red flag. You want to understand where you are every day with your business financially. So if you're a business owner and you don't have any accounting skills, take a basic accounting course. You can read some books so you have a clear understanding from a basic level how to read your statements, your P&L, your balance sheet, your AR aging, your AP aging, the different balance sheets, ratios, what they mean. Once you can understand that, you be a better business owner when it comes to bank financing because you understand what your numbers are and where they're going to be. And I'll pause here. So again, I'm Rashad Todd, State National Bank, and my colleague Courtney Davis, State National Bank, and I will stop sharing my screen and I will open to Q&A.
Thank you, Richard. As you mentioned, the Q&A is open, so folks, please feel free to drop in your questions.
Yes, please do. You have two bankers here with decades of experience. Again, no question's a bad question. If you have any questions about your industry, when it comes to capital, when it comes to anything revolves around your business, please ask us. Again, it's no bad questions.
Could you start us off by sharing like maybe your most frequently asked question?
Yes, I could. Thank you. That's a great question. So right now, the most frequent question is how to receive capital. Where do I go? A lot of times I get that question from startups. Now, a lot of banks don't like startups. Some banks do live in startups, but they utilize SBA. Banks like to operate on some 3 years of history. So you need at least 3 years of business to require to apply for bank financing. Now, some banks that utilize startups are like community banks, and they partner with the SBA. So you can Google SBA top lenders in your area and go find them if you're a startup. If you're a growing business, talk to your current bank, talk to your CFIs, talk to your CDCs, talk to your economic development associations, get a better understanding of what programs they offer. If you're Virginia, talk to your SBSD. They got numerous programs for cash. If you're having a collateral shortfall, I know the Virginia SBDC has a program for that. It's called Cash Secured or Cash Collateral, phenomenal program. So again, just being able to understand your options you have for capital beyond banking, beyond banks. So, and also utilize Allie. She has a huge network, huge team, and she can point you where to go for capital. That's the main question I get is how to receive capital, where to go.
Can I just add something there, Rashad? One of the things I've been in banking for over 25 years, and one of the things I want you all to just think about for a second is as you think about last year, you think about this year, you think about what's happening in the economy right now. So last year we had tariffs, right? Tariffs was a big topic. How tariffs is going to affect your bottom line. And then when you think about this year, what's a big problem now? We have a war going on, right? And so the cost of capital, the cost of everything that your input in your business has gone up. And the question I want you all to think about is something that Rashad said earlier, which is proactively planning ahead for credit, right? Because if you don't proactively plan ahead, when these headwinds come, when the war comes, when tariff come, you're not going to be able to take advantage of it because guess what? You're not going to have that facility so you can pull on it. For example, if you think about it, just think about the guy who, had a nice line of credit last year and he put that line of credit in place. He might not have used it. He might not need to use it. However, when those headwinds, when those unforeseen circumstances hit you, it allows you now to pivot and be able to take advantage of them. And so I'm just saying this to all the business owners on the line. It's so important that you proactively think about what you're doing, proactively seek out capital ahead of the need. Don't be reactive on it. Don't wait until it becomes an immediate need, right? You want to do it 3, 4, 6 months before, because when you're able to do that, you're able to get the best possible rates. You're not putting your business at risk. You are able to be more competitive than your competitors who are in that field because you're able to pivot and take advantage of that opportunity that comes along. So I just thought I'd just share that particular piece because that's one of the biggest thing I think. And so I would say one of the best person you want to talk to about that is, of course, the Virginia SBDC. They are really, really great at having those type of conversations because those type of conversations help you to plan ahead.
Yes, Courtney, and I'll let this on for that. He has perfectly explained that sea of conditions and the 5 C's. Understanding how economic can affect your business. If you can understand that, you can plan for that and not be caught in the tailwind of that and have your bit of under pressure. So always apply from strength and growth and comfortability, not when you need it the most. COVID, we've seen that a lot on COVID. Another question I get a lot is for government contractors. Are banks still lending to this industry? In the DMV, as I know, that's probably 3/4 of our business, maybe more. And a lot of banks are lending to government contractors, but they're doing it from a place of more being disciplined. During COVID, we had a perspective of growth. And towards the end of last year, now this year, banks are more so on a perspective of being disciplined. So we're diving more deep into your financial requests. So I'm not saying we're tightening our box, we're not. We're just looking at deals more disciplined. So understanding if you're a government contractor, understanding the industry, your backlog is key. You're funded. That also plays a part. Understanding how much you've been paid, the contract type, again, who's it with? If you're in the 8A program, if you're in the 8A program, when does it expire? Things like that plays a key when you're a government contractor. If you're a commercial contractor, understanding who your contracts are with, state, federal, anchor business like like Amazon, things like that, those also plays a key. And then for my businesses that are seasonality, understanding how your business fluctuates throughout the month is also key. And again, you can plan for the capital once it hit. Owners who are proactive rather than being reactive tend to get capital a lot quicker and better rates. So I don't want to say easier, but better rates. So again, any questions? Again, there's no bad questions. If you're being shy, I may call on somebody. I'm joking, no, I won't. But any questions, ask me and my colleague Corey Davis, and we'd be happy to assist you guys. We got about maybe 5 minutes left. And again, I'm Rashad Todd, and I cover the DC market, the Maryland market. For Maryland, I cover PG County, Montgomery County, Charles County, and Frederick County. I cover Virginia as well, and I also cover a small county in West Virginia. I think it's called Jefferson County. Yes, Jefferson County. My colleague covers New York, and he can better explain to you his territory.
Yeah, my territory is New York City, so I cover the boroughs of New York. The program is only available that we do in Manhattan and Brooklyn. But nonetheless, we are always, when it comes to business literacy training, I do that training in the entire five boroughs of New York City. So, we want to make sure that we're there for you as a small business owner to really and truly help you, giving you the information which is going to help you to make more informed decision, because ultimately that's what it comes down to. The small decisions that you make in your business day by day is what in the long run becomes the ultimate um, final position that your business takes, whether it be a good position or a bad position. Any more questions for us?
Yeah, it looks like we've got a couple in the queue. First one is, do you have any lending resources that support minority-owned startup businesses?
That's beautiful. Great question. Love it so much. So I'll say this. Any questions that are around what Sage National Bank offers, you can give Ali an email and you get my contact or Davis, and we can better explain to you what we offer as a bank and how we can assist you. Because we do offer one-on-one consults. So to better understand again your short-term, long-term growth plans, and even if Sage National Bank doesn't offer these program resources, I can find somebody that does within my network.
Thanks. And just a note, I have dropped my contact information in the chat for anybody who needs it.
I think we got two more questions. Okay. One went away. Are there any programs available for those who have poor or no credit? If so, what aid is out there in the VA area? So when it comes to these programs, there are programs out there. A lot of times you can contact the SBA, again, contact Allie and her team because they can better assist you with navigating that pathway towards capital if you're having credit challenges. That might be the last.
Just kind of to add to that, to the response to this last question about credit, Capital Pathways, as I mentioned, is working on a credit building advising. So if that's something that you'd be interested in, please reach out to me and I'll get you connected with that resource.
Perfect. Yeah. Listen, she's a great resource. Whatever you guys need, trust me, give her a call, shoot her an email, and she can point you in the direction of where you need to go. Or it's capital, credit needs, etc. If you need my help, she has my email, my phone number. Give me a call, and I can also give you a one-on-one call. So me and Courtney do things free. We don't charge anybody. So any questions you have, I don't care if you're a 15-year-old business or want to start your business, give me a call and I would love to assist you.
Alrighty, with that said, I believe our time together has come to a close. So Courtney and Richard, thank you so much for the wonderful information you shared today. To all of our participants, thank you for joining us. As we said, if you have any additional questions, shoot us an email. My contact information is in the chat and I can connect you with Richard or Courtney if your question is more specifically for them. A recording of today's session will be sent out via email within the next week for all of our participants today. And I also dropped in the chat a link to our other webinars, so please do check those out. We cover a wide range of topics. Thank you everyone for joining us.
Thank you, Allie.
Bye-bye.
Have a nice day.